Okay, great. So our official topic or name of our workshop today is understanding debt and equity. Before we go into either of those, I wanted to start a little bit with just picking up where we left off on a previous webinar on cash management. One of the key things that came up in that and will come up for everyone every day in the course of their business, and frankly in personal lives as well, is that cash makes things run. And at the end of the day, no matter how good or bad everything else might look on the books, how fast things are moving, how much the sales might have slowed up or down, how costs are increasing, how you may have negotiated really good deals with your suppliers and vendors. What really could hold things up is not having cash in the bank. Or on the flip side, what could smooth things over and make them run better is having that cash in the bank. And so we want to approach our sort of inroad into talking about fundraising and figuring out what financing looks like for the business and how it might make best sense to approach it by having this piece that is very fundamental, just top of mind for everyone. It's no fun having no cash. So if you don't have the money, no matter how much is promised to you and how much is outstanding from your customers, how good your terms are with your vendors, things are not moving forward. And so starting with that, our objectives today are really to explore modes of fundraising that help you address needs that your cash flow forecast might have brought to light, and then use those modes that we speak about today to then help refine your cash planning approach and to see what makes sense for you in your business. Financing is an interesting ballgame in general. It's an interesting sort of field to play with because there are so many options available, but not everything is available to everyone. And also, even if something is available to you, it may not be the right time or the right mode for you to have that money. And so this is something that we want to underline alongside as well, is that having cash is important, and getting that cash, if it's coming in to your business through whichever mode it's coming in, getting it in the right way, a good way, a way that actually helps sustain and keep your business viable is equally important. So let's talk fundraising. When is the time to consider external funding? And by external funding, we mean any mode of bringing in money outside of just selling your core product, which is a sale. And the right answer, frankly, is before you need it. Because again, it's really, really hard. It's impossible, and just put it that way, to operate when you do not have cash in the bank. So some of the key things you want to be thinking about are before you actually get to that point of needing the cash. You know, when do you need cash? You need it yesterday. You want to think about getting it before that yesterday arrives. So some of the factors you want to be thinking about potentially as you're bringing in money into your business is, why are you thinking of borrowing or requesting investment? And by borrowing, we're thinking about debt, you know, any form of loan, etc., that requires a specific payback that has terms around it. Or requesting investment could be coming in as actual investment into your business, where in exchange you're offering some level of ownership or equity to the person who's bringing it in. So why are you thinking of bringing in that money? What is the rationale behind having that external cash come in? If you have it available to you, another factor to think about is how much should you be borrowing or accepting? All that you can get is not a great answer. So basically everything that you bring in should have a plan associated with it, because cash, any kind of cash, is not free. There is always a level of payback associated with it. What are some sources of financing that work for you today, for your business, for your lifestyle, for your plan, and for your ability to pay back? And what are the terms associated with that money as and when it comes in? So just bringing this all back to, when is it time to consider external funding? Again, before you need it. And there are many stages or points in your business where it may make sense to bring in external funding. One of the very first ones is as you're thinking about business inception and growth, starting operations. Oftentimes at this point in time, these external funds are your own. You as an owner, as you're starting out a business, are bringing in money into it. You may look at that and say, oh, but that's not external funding, that's my money. But it's your money. It is just as anybody else comes and invests in your business, this is equally an investment. And in fact, I would say you're more on the hook than anybody else, because you're not only putting in your money, you're also putting in your time and your energy alongside. So consider it an investment. You may need money, or you may need cash. You may need to think about external funding to be able to maintain a steady state pace of growth. Just to have, sometimes things are running smoothly enough, but you look at the fact that something might break, and just being able to make sure that you have enough of a cushion to recover from that break is a point at which you might need external funding. And a third state, and this is literally to say anywhere along the business life cycle, might be a time when you may be thinking about getting external funding. Business growth, when you're essentially looking at making a move towards expanding. It could be an expansion of product, it could be an expansion of geography, it could be an expansion of where you're selling. This is not to say that you need to bring in funding when you're at these stages. It is to say that these might be inflections or points in your business where you might sit back and say, okay, I need additional funding to support this plan. And therefore, step number 2 is it really worth it? Should I be doing this? Is it the right time to bring in that financing? I'm going to keep pausing. Justine and Skya, please just jump in for us to take this together.
Yeah, I did have just one thing to add, or I guess to stress more than anything. I really wanted to stress, like, before you need it. As a lender, some of the times people come to us and they're like, hey, we're trying to do this and I need the money yesterday, and as a lender, that is a really hard situation to work through and to try to be able to meet those needs, especially as a CDFI, where it's also our model to provide technical assistance. So when you're thinking about your business and where you're at today, point A, and you think about point B, C, D, and point Z, think about like where you're going to need financing, start those conversations early and be thinking about it and have it a part of your business plan so that you're not coming in a little late, because oftentimes it's really, really hard to meet those needs then.
And I can, from a producer standpoint, that everything that they're hitting on here is 100% correct. I've been also the one that is calling Skya and being like, Skya, I need help now. So she's got me trained up now after a few years of working directly as a producer with Akiptan. But it is essential to start building those relationships as we talk about growing our businesses, and for a lot of us that is getting into a value added diversified product situation. When we first started selling beef to the public, we were just basically like everyone else at that point, and we had some beef that we were like, let's finish them out because the calves are not bringing in the money we need the additional money. But when you actually sit down to look at what that is doing for your business and how you can grow that, it's really important to start putting some of that on paper. And I know we're going to hit on that in just a little bit. But one of the things, we're talking about is business growth. And we have found that sometimes, rapid growth happens, and that's great. But one of the things that I want to really impress upon you guys as producers and from producer to producer is make sure as you're growing, your quality of your product stays the same. Your quality of the processing of your product stays the same. We've experienced different situations with processors because we use external processors for USDA stuff, where they're processing much faster than we would like. And so we have to slow them down so our quality of our product we're selling is the same. So when we look at that business growth and we look at the equity and debt servicing we need for that, making sure that we put these things into a business model and a business plan. So when we go into our lenders or our CDFIs or even to grant opportunities, we really have a strong business sense of where we're headed for that plan ABC all the way to Z. So
Thank you for that context. Super helpful to have. So moving on to speaking about modes of funding. Where does funding come from, or where does it make sense for funds at your, again, like we keep saying, at your stage of business, at your type of business, depending on all of those other circumstances, where does it come from? Typically, when you're thinking about funding, there is a hierarchy. There is what could be really great to get. It might not be easy to have access to it. And then from there on, starting to see where you move to from there, depending on what's available to you. And typically, one of the best measures of funding is aiming for lowest cost, but not just lowest cost, but high quality funding alongside that. And what do we mean by that? A lowest cost is really where literally the cost of payback is one piece of it. How much are you getting this funding for? What are you going to have to pay back alongside paying back the principal that you get? That's just cost in terms of actual cash. And then there's also the cost associated with the time that you have to put into it, both to get it, to then maintain a relationship around it, and then to work towards the payment of it. So lowest cost could mean, the cost doesn't necessarily have to be there in terms of dollars, but having low cost funding is probably something that puts having a low cost term associated with it is probably what puts some funding options on top of your hierarchy. But alongside that, quality is equally important. And by quality, we mean how solid the source of funding is. If you are, for instance, working on receiving access to funding that comes to you, just as an example, it comes to you in tranches, and you essentially pin your plans on receiving funding at specific points in time over a period of time, knowing that you're committing both a payback schedule and a significant amount of time to getting this. And that source suddenly disappears along the way. It is clearly a loss in time and a change in strategy for you that doesn't pay off in itself. So quality is equally important when you're looking at sources of funding, to know that the source of funding is not going to disappear, is going to deliver when at the promised times in the promised ways, is not going to suddenly change terms on you because of something that's happened on their end. and then also how it affects you as a business to be associated with them, which is something that, you know, again, there could be positives and negatives associated with this. They having access and availability, funding availability may open a whole set of network and communities access for you. And on the flip side, if there is a negative connotation associated with that funding, and it could be negative for a number of reasons, personal values, how that particular funder affects the environment and communities around you, what kind of reputation they have that you may then carry on with you. All of these pieces work into what the quality of that funding might be. So generally, when you're looking at a hierarchy, you may be looking at something and either say, hey, this is too expensive and start pushing things down the line, or just plain dismiss some options to you because they just don't align with who you are as a business and how you work. And that's what starts to create your funding hierarchy. The ability to then renew and grow that funding as you need it is also important, because oftentimes raising funds is a job in itself. You are putting in so much time in putting your information together, ensuring everything is accurate and up to speed, and providing the information as people ask for it, and then working with them to maintain those relationships. It's a huge investment of time. So ensuring something that might affect that hierarchy is the ability of that lender or that source of funding to grow with you as you grow as a business, or for you to acknowledge this is how far they can help me, and that's okay, but be aware of it upfront. We're going to go into some examples from here of what could fall in a funding hierarchy. Starting with, you know, in quotes, free money. We have this in quotes because nothing is free. There's no such, what's it called? There's no such thing as a free lunch. So free money still involves a time commitment from you, and often a relationship and a reporting commitment. What qualifies as free money? Some examples are grants that may be available in your specific geography for your specific type of business, or nationally for your type of business, depending on, you know, depending on the time of the year, depending on government availability and what is being opened up in terms of programs, depending on the existence of certain foundations or collectives and so on. Grants are a very interesting source of funding because, number one, they are free, in quotes. They're a grant. They do require a heavy commitment often, in terms of time, the time associated with the application and all of the information you have to put behind it to be able to access it and to make sure you're eligible for it. There is often also a reporting commitment associated with grants to report the impact, to measure what you have achieved and to be able to deliver on it. And then there may be other implications associated with whether something is taxable or non-taxable in terms of that income or the funding that you have received from the grants. So when applying and looking for grants, it is definitely a very solid source of funding, depending, again, on the source and everything associated with it. But something to be aware of alongside all the time is the time, both in terms of application and oftentimes the time between the application and the news associated with the receipt of the grant, and then how that grant is disbursed. You don't necessarily always get the money up front. You may receive a grant where you have to spend the money, submit the receipts, and then get the payment associated with it. So this can be really impactful on cash flow. And it's something to be well aware of upfront as you're going after this kind of money. Competitions and awards associated with them. So oftentimes we see, you know, there are opportunities. These might be small and they might be scattered. And again, it's a question of how much time you want to be putting into this, both scouring what's out there, then being able to put all the material together, then being able to represent, and then potentially being in the running to win. But this is money that is, comes to you with technically no strings attached for payback in some form. Gifts from family. The limit changes every year. This year, you can receive up to 15,000 per person as an individual from a specific individual with no tax consequences. So if somebody among friends and family is in a position to be able to gift you or your business that money, it is possibly better to structure it so that you receive it over a number of years instead of waiting for an inheritance all in one that has massive tax consequences associated with it. There are lenders, Kiva being a prime example of community-based lenders that essentially help or encourage you to pull together your community in funding you that you can then pay back in installments at 0 interest. All of this is, again, in quotes, free money. Each of these requires significant amount of time alongside in working towards getting them. But they're good resources and ideas to have in mind, because sometimes you might find a great fit between what's available and out there and what your business needs at that point in time. Pause.
Yeah, just about the free money, the grants, they are great, but do just be conscious of the time commitment that you will have to spend on, applying. If there's a first round, a second round, the reporting, and we'll kind of talk about reporting and covenants a little bit later. But it's a large time grab, and that also does take a little bit away from like your working hours for your business. So just make sure that you're spending your time where it's most effective and most efficient. And then if it's with a private grant instead of a federal grant, perfect. If it's skipping out on this smaller one to then go after a bigger one, that's fine. But yeah, just the time commitment of grants can be really heavy depending on the requirements and stuff.
I'm going to jump in here quick, because we have, as a company, we have went out after some of these grants, both on a small scale and large scale. For all of our producers that are on the call today, I know Olivia just put in that in June or July, I believe they are going to be hosting a segment on grants. I encourage you all to attend that. IAC has some great technical assistant helpers out there. There is a number of people, whether it be with rural development or USDA, that can help on some of these larger grants. One of the grants that we received as a company was the value added producer grant. And without that, we wouldn't be the business that we are today. That being said, I'm a little bit frustrated, and I've expressed that at the national level, that they put that grant out in mid-March and it's due mid-May. In my opinion, for those of us who are producers, whether we're livestock, crop, vegetable producers, this is kind of our crunch time. I mean, we're calving, we're getting ready to plant, we're sowing seeds, we're doing all of the things. And so it's really hard to put a grant together of that magnitude in 2 months. The deadline for that is May 11th. And so, finding out about it today is probably not the greatest to throw together in 3 weeks. I pulled up on my other screen here. I wanted to know how long my grant application was for that particular grant. And my application was 45 pages. I don't want that to scare you. There's a toolkit that is put together. It has been the same toolkit for the last 3 to 4 years. So if you are looking at going after a value added grant through USDA, I would recommend downloading that today, and starting to look over it and prepare yourself for 2024 on that big grant. Now, I know some of us have state grants that are available when it comes to doing local foods, which is exactly what we're all here to discuss. So I would really research at your local level, state levels as well, because there is some competitive grant monies out there for a lot of us. One of the other things I wanted to bring up here, when we talk about gifts from family, those can come from the most unexpected places. We have struggled with Farm Service Agency for a number of years. And we've had to look outside the box. And one of those boxes that ended up being checked for us was a friend's family member who we've never actually met, provided us a bridge loan to buy a property in order to basically move Mr. Beef into a different location. With that, we were doing a bridge loan basically between closing the ranch that we were selling and Akiptan, and she was able to do that for us. I would have never asked, but I happened to be just bitching around, for lack of better terms, about our situation with Farm Service Agency and how we were really lacking any support. And the gentleman who had been on and off living with us as a dear friend, a little brother-like person, he said, well, let me call my mom. And I'm like, don't call your mom and tell her my problems. God, for real. He's like, no, like my mom, she loves you guys. I'm like, I've never met your mom. And she was able to provide us that bridge loan for 6 months until we could sell the ranch and get the new property bought. You just don't know until you start telling people your story and tell them what your business plans are and why it drives you to do what you're doing. So, you know, sometimes when we talk about funding and cash flows, it's so stressful, and we get so bogged down because there's never enough money, right? We're always looking for more. Tell your story, explain why you're doing what you're doing. It's important work. It's important to feed our nations and our local communities. So you never know what's going to pop up, and always be willing to say yes. My husband was going to say no to that because he was scared. He's like, I'm not taking money from somebody. I'm not. And I'm like, no, we are. We need this. Like we're desperate. And it worked out great. And now I know I can call her if we needed an injection of cash. You know, it's a nice partnership that's been established. So keep your chin up if you get down in those, you know, in those trenches, because things are out there, and you know, we'll be here to help you.
All right. Other ways, other things that come on this hierarchy, customer supported models. I love this one because it's essentially you're selling what you're making, you're selling product, and it's a way of potentially receiving that revenue upfront. You may already be doing this if you run a CSA. That's exactly what it is, because you are requesting deposits or subscriptions upfront for product that you'd be delivering in the future. The one thing to be careful about customer supported models is not to overpromise what you are going to be delivering in the future. And this can happen in a couple of ways. If things don't go according to plan, let's just say, in terms of yields and harvest, you might have oversold, and then you're on the hook for not just returning that cash, but also losing credibility as a business. It makes people lose trust. And so making, you know, having that cash up front is great. Being able to deliver on it is the more important thing. It's really hard to have to be in a place 6 months later when you're delivering, finding you're short, and then having to find the cash to pay back alongside explaining the gap. The other way of overselling in this case is we worked with a number of companies that put together, you know, some level of crowdfunding. So for instance, It may not be a subscription-based model, but it may be some level of funding that's associated with, hey, if you hit these milestones, you'll be receiving this from us. It's interesting. It's a great way to get the community involved. I'm all for it. However, the thing that we've seen and a danger to watch out for is that you don't, again, overpromise, not just overpromise product, but underestimate the cost associated with delivering that product. I've seen a couple of situations in which the product is there, it is ready to be delivered, but nobody estimated what it would take to literally physically get it to the customer. And these days, particularly in a post-pandemic world, when logistics, distribution, shipping costs are through the roof, it's something to be very aware of if you're bringing in this kind of funding, that you take into account all of the costs associated with then getting that product to your customers. Don't underestimate that. And so customer-supported models are actually, frankly, one of the most sustainable ways of getting in financing. You're bringing in funding for product you will deliver. You know, just make sure you're tracking your costs alongside it. And I always say, I heard somebody say this yesterday, and I really liked it. I generally say I'm on the optimistic side of realistic when I think about planning. So you have, you know, here's how things could, like, here's worst case and here's best case. I settle for somewhere in the middle and move towards being a little more optimistic. And somebody said yesterday during a call, you know, if we have 0 to 10, we're generally at 7.5. And I was like, that's it. Like, that's what we're, you know, so estimate in a way that feels realistic to you and works with your growth goals, but don't overpromise. If you have more product than you had planned for, that's great. You have more to sell at a later stage. But, you know, better to have that than be the other way around.
I would say, in addition to that, be honest with yourself about your capabilities. Be honest with yourself about what your land can produce, what your cattle can produce. If you're expecting, you know, a 60% yield on whatever it is that realistic for you? Have you looked at your numbers? And always be honest with your customers. We just had a situation literally this week. Got a call from the butcher. They've been our butcher forever, and they're like, hey, this steer that you brought in is actually just going to be, I mean, he's not up to the quality that you need it to be. And I had already sold it to a customer who's bought from me for 3 years in a row. And it was that oh shit moment. Like, what do I do? I've sold this critter. He's not up to the quality that I demand out of our beef. So, okay, we're going to burger him. He's still going to be worth something, but what do we do now? It's a simple phone call sometimes to say, hey, Hugh, guess what? This beef isn't up to our snuff, so I'm not going to sell it to you, but I have another one coming. You're going to have to wait 6 weeks till I can get into the processor. Let me know what I can do, you know, to make sure you guys have beef in your freezer right now, and I will get this next beef to you. And it's just a matter of having that flexibility and that honesty to say, you know what, sometimes things don't work out. I'm sorry, this is our bad. Let's make it right.
Almost missed a page there. Bootstrapping, using your own resources to fund and, you know, putting some skin in the game. Pause right there. You already have skin in the game if this is your full-time job. So if you're looking at putting in more of your money in your personal funds and savings into the business, don't forget that you have a personal life to support alongside. There have been instances without count of somebody putting business owners putting everything on the line for that one last bet to make things work. No one's saying you shouldn't commit. You're getting in here, you've already put in the time, you've made decisions to focus on this as opposed to working on something else. And so it makes sense for you to commit wholeheartedly. That being said, keep, we say this, it's a key principle in anything associated with numbers in your business. Always keep business and personal apart. Separate them, see what you need on a personal level, and don't compromise that. Don't put your house on the line if this is the only house you live in and this is what you have. This is the roof over your head. Don't put things in within your, don't compromise or don't collateralize. Don't put forward things that you cannot afford to lose in your business. Something that compromises the quality of your life if everything fails is not worth putting in there. And this is it's a hard line to define, because you may look at something today and say, I am well aware of the risks and I know I want to be in here, and I know that there's going to be a certain level of payback associated with it that is going to help me earn this back, and that's fine. It's our job, as we're talking about this, to make sure that you're aware of every possible, risk, not just risk associated with that, but to be able to look squarely in the face at that note that says, if things don't go according to plan, and this is the worst case situation, can I live with it? What am I going to do? What's plan B if that happens? So do everything that you can to stretch your resources, sure, because this is something that you have chosen to do and give your all to from a business level, but don't compromise your real personal assets if you don't have anything else to fall back on. I feel like there's going to be input here.
Yeah.
So,
a couple of things of just like things that I've seen that producers do. I feel like they resort to this a little bit when their back's up against the wall, is kind of what I've seen. And I've seen people, dip into their retirement accounts or sell some of their current assets to get by. And I hate those positions and producers having to be in those positions. So when it gets to that, I would, can you replenish those funds in your retirement account? Like, what are the odds? But also if you're having to sell assets to get by, make sure to also have the long game in mind. It might solve your problem for the next month, but is what you're doing going to have negative impacts after that? So just a couple things to keep in mind. If there's just some, old equipment or old assets that you don't use anymore, and you're like, hey, I'm going to sell those and that's going to be my startup funds, perfect. But if it's assets and resources, machinery, equipment, whatever it is that you are currently using, make sure you've got the long game in mind as well.
Yeah, I think as a producer, we are terribly guilty of all of this. And I say guilty in like the best way. I come from like a business background, like that's my entire like education and all of that. And we still do this. We still struggle to find that line between personal and business separation. One of the things that I can highly, highly recommend, and it is so hard, and I will tell you that like just recently, too late than I really want to admit, like I would say in January, we've been running Mr. Beef as a business for probably 5 years. I finally got our own account, our own checking account. So our ranch has a different one, but there is something to be said about getting that checking account and getting your business running as a business. In agriculture, we are all guilty of, we're going to make it work at at every cost, because we're going to keep the land. We're going to figure out a way to keep our cows and keep our crops going. And sometimes we have to sit back and really evaluate, like, is this working? Right now, my family's doing that directly. You know, we really amped up our beef business in the last, 2-3 years. But is it still working? Is it still putting that money back into our pockets that it once was? Do we need to, pivot again and start doing more calves and continue our finished beef product and do both? We have to be willing to look at all aspects of our business, and be able to diversify and make those pivots when we need to. And one of the things that we are incredibly terrible about is, it's okay, mom's got a job in town, it'll pay for this, so we don't have to worry about the ranch this year. But we also need to make sure that our agriculture business, our value added business, our meat to market businesses are making their own weight. And how do we do that? How do we help you guys to make your own business prosper? And this course is in its whole is the whole purpose of doing that for our producers. So stick with us. The meat to market crew is definitely teaching me things, and so I'm hoping you're gathering that too. But definitely there has to be a little bit of separation between what is business and what is personal in our lives.
Accelerator models, incubators are another way of obtaining some level of support for your business. Many of these collectives, organizations exist. You're aware of them. You're often a part of them. Something to know with respect to entering a program is that there is often can be a cost associated with it, and sometimes there just isn't. The point here is for you to fully evaluate what you're looking for, what you're getting into when you apply to a program, for you to be aware of what is at stake, what you need to deliver, and actually look at it honestly from both sides of the equation. What do you have to pay up? It may be a piece of the business, it may be a fee, it may be some level of sort of, future commitment to working with the organization. It may be a set of reports that you have to deliver over time and be able to stand behind. And whether it is anywhere from reporting to actual hard cash to a piece of equity in of your business, being aware of what you have to be doing and being, let's say, open and honest with yourself as a person and as a business, that you are able to commit to that, is a huge part of making this a success. If you find that you are unable to support it for whatever reason, you're just too busy, or the money is going to be too much, that's a good warning. Please do not go into that. If handing over equity to an organization that you're not entirely sure about feels iffy, those are good things to evaluate before you actually get into a program. We come across companies and ranches and farms that literally spend all of their time looking for programs and then applying to them and then potentially getting or not getting into them. And it's a huge sink of time and resources to be able to do that, to be doing this. And then potentially once you get accepted, there is still a commitment associated with what you're going to be doing within that program once you get in there. So being well aware of what is required upfront and the kind of support and return that you're getting is worth the effort before moving forward with a program of this nature. That being said, many good ones do exist, and they may not bring you hard cash, but they could bring you a lot of other support in the form of technical assistance, professional development work, land resources, and other forms of benefit that may be in some ways even more beneficial for the business and the support that they provide. Okay, we're going to move into speaking about debt and equity specifically. And a large part of what's coming up is really focused around debt, because many of us in this particular stage of the business and where we are today have more access to debt, are more willing to take on debt for good reason. And this may come in many different forms depending on what our need is and how the business is structured and where it's situated. So we'll spend some time talking about various aspects of debt. Justine, Skya, and I will each chime in with, again, with stories, experience, and just some of the specifics to keep in mind as you're working with it. Some key factors to think about when you're looking to take on debt. What is debt? It's the acceptance of your taking on debt or a loan is the acceptance of some amount of money that you are then promising to pay back with a fee associated with it. And that fee might be a percentage of how much you have borrowed. It might be a fixed fee that you have to pay no matter what. It might be some other form of payment, depending on how the debt is structured and who it's coming in from. Sometimes it might be 0%, like we talked about with the Kiva loan. You just pay it back over time. So one of the first things to think about with respect to debt is the amount itself. How much do you need? And that depends on what you're planning on using it for. How much are you looking to bring in? Sometimes the need is very clear. You need a certain amount of financing of debt to come in a way to support an initiative. And you find that you have the option of going after one or two sources to bring you that money, or 10 little ones. And just the work involved in going after the 10 little ones, even though they might be the easier route to go with, for instance, to say, oh, it's going to be easy for me to get. Just the administrative work in handling all of the communication and everything may switch you over to the other side. So when you're thinking about the loan amount is not just how much, it's also starting to think about, okay, if this is what I need to bring in to move this initiative forward, where is it coming from? And how can I structure it, or how can I work with my sources to be able to get the maximum possible from one source, as long as the cost isn't prohibitive? So how much you're bringing in. Loan structure. How that loan is structured is going to hugely affect how your business may be affected in paying it back. Debt, typically, there are many forms that loans can take, but two of the very sort of common forms are a term loan and a line of credit. A term loan is when you receive the money upfront. It is in your account. It is now yours and the clock is ticking. You have to pay back, and there's a fee associated with paying back. And that payback might be equal amounts on a monthly basis or on a quarterly basis, some sort of periodic basis, or that term loan or that payback may be associated as just a specific fee, the interest payment on the debt, over a period of time until you get to the end where you make a balloon payment and pay back the entire principal. But essentially, as far as the term loan goes, the clock is ticking as soon as you get the money. You are now on the hook for paying back alongside a fee. A line of credit is kind of very similar to a credit card in the way that it functions. It means that you have credit available to draw on, but you don't have to use it. You only pay on what you use. And once you pay back, that credit is still available for you to draw on anytime you need it. It will be available to draw on until you hit the maximum. and you pay an interest fee payment on it alongside what you owe, depending on how much you've used. What you have access to is one thing, what you might need is another. Typically, a term loan works well in situations where you already have a plan for the money. So for instance, you need a piece of equipment, and the financing associated with a term loan works out well because you receive the money, you immediately pay for that piece of equipment, and now you're making payments back on that loan that you received. A line of credit, on the other hand, is a good thing to have when you need cushion for the business. You don't necessarily know how much of it you're going to need, but it's a good thing to have in a moment of cash crunch, and then you pay it back as revenues come in. And so it's basically there to support the need. Depending on the terms associated with the two, you may find it often turns out that a term loan is, it often turns out that one form of debt might be more expensive to use in a particular situation versus the other, which is why it makes a lot of sense to think about how you're going to be using that money in addition to how much you need. So loan payment terms, which we already touched on just now, are equally an important thing to consider. And interest only with the balloon end payment could be interesting for a business where you don't have enough cash flow to service full, steady monthly payments. But the thing you have to then be careful about is 2 years in or 5 years in, you've got to be ready to pay back that full amount, because that's the end of the line for you. Steady monthly payments are a little less scary that way. They do mean that you have to allow for the cash flow on a monthly basis and have it be available for payback. And there's no sort of sudden, it's not a surprise. A balloon payment's not a surprise, but at least there's no sudden shock associated with a massive payment. Either way, if you've planned well for it, both of these could work. It's a question of knowing what the payment terms are and then being ready to service them. Loan duration, how long do you have to pay this back? This clearly affects, not just what your monthly payments are going to be, but also how much you might be paying as a fee, the cost of having this debt. The interest rate, very critical. How much is this going to cost you overall? Sometimes you just have a fixed fee. They say, here it is. This is what you're going to be paying back as a fixed fee. You need to be careful of that kind of loan, because typically a fixed fee could mean that this is more expensive than having an actual just rate associated with the principal. Loan fees, this could really add up depending on how the loan is structured. Sometimes there's a loan origination fee, and then a transfer fee, and then like a payback fee if you suddenly have the money to pay upfront, like a penalty for just paying them upfront. And so this is often depending on who the lender is and how money's coming in. Actually, okay, no, I'm going to come back to that in a second. Loan fees, something to be aware of. And then collateral. What are you guaranteeing in terms of in return for receiving that cash? Oftentimes, a loan might even ask you for a personal guarantee. Everything that you have personally is on the line if you're not able to pay back from the business. And you need to be aware of this. What I was going to say with loan fees, I'm going to say with all of this. Everything is negotiable. Everything. I'm not saying that you will succeed, but in negotiating better terms on the debt that you bring in, but just know that everything can be or should be attempted to be negotiated. And some things are easier to negotiate than others. Generally, in my personal experience, and Skya, Justine, I'd love to hear yours on this, loan fees has been one of the things that we have very successfully negotiated, often in having things omitted. It's one of the easiest things to get down, as is sometimes just a quick, few basis points of the interest rate. But typically we always say, if you've started to receive terms from a lender, push back to try and get better.
Well, you can't negotiate loan fees with us because we don't have any. So, but there's reasons for that, and I'll talk more about Akiptan specifically later on in a different webinar. But yes, I think negotiating or pushing back is always super important. And whether it's loan fees or some of your terms, good capital that meets your need and is patient and logical enough for you to repay it back at a reasonable rate and time is instrumental in your operation. And so if a banker or an investor gives you terms that you just don't feel are fair and that aren't going to work, say something. You kind of touched on it earlier, Anjali. Saying no sometimes is way better than saying yes and ending up in a bad situation, right? So I would encourage that pushback and giving that feedback to whoever you're working with, whoever you're taking on debt with, or in order to make sure that you are setting yourself up successfully. If you have to accept terms that aren't realistic for you to pay back, it's gonna end in a not very good way. It's almost better to just say no and put your plans off for a couple months and try to find a different lender than to take one back, to take debt that isn't going to work. And when you're analyzing certain stuff like this, I've seen it multiple times with producers. Please make sure that what your impression of the terms are also specifically what's listed in the loan closing documents. I've had many producers come to me and be like, well, I thought that it was going to be a 5-year note, but it ended up being a 3-year note. And sometimes there's miscommunications, misinterpretations. Some lenders aren't always super honest and transparent. And so, they're thinking one thing, but they end up doing a different thing. So be very, very sure and very, very careful that when you're closing, you see specifically where it's listed out the amount, the structure, the terms, the interest only versus with a balloon or interest only and then blended. And are you going to have to be making monthly payments? If it makes more sense for you to make seasonal payments, you can also negotiate that payment stuff as well. But yes, watch out for the loan fees. There's closing fees, filing fees. Sometimes there's a 10-day grace period and then there's a late fee applied. Sometimes there's fees applied for early repayment, like there's prepayment fees. So if you have a 5-year note and you pay it off early, you paid in 4 years, that's usually really good. But then banks lose out on earned interest. So then they might charge you, not always, but they might charge you like a prepayment fee. And so there's just different things like that to look into and to be aware of. That way you've got all the information to make like really well-informed situations. Collateral is super important. Make sure. So sometimes banks, especially with agriculture operations, it's very common. Banks, like if you go to a bank and you get financed for cows or you get financed for a barn or something, oftentimes banks will take more collateral. So they'll do like a blanket agriculture lien is what it's called. We see it a lot with cows, with machinery and equipment or other stuff. Sometimes it's isolated to just that piece of equipment. Operating notes often have blanket liens, and that means that they are taking interest in all of your ag chattel, which means your livestock, your equipment, your infrastructure, any farm vehicles. They are taking interest in everything. That's very, very common in Indian country, but make sure you know that because that can affect lien positions and all different stuff like that. So you'll also see that in your security agreement, and they'll use that to file the UCC, which is them staking their claim in your stuff. So if you're getting an operating loan, make sure you know what you're pledging for collateral. If you're getting that line of credit to run your business, make sure you know what you're pledging for collateral, because banks oftentimes like to take above and beyond the 100% collateral match. So just some things to know when you are looking at taking on debt.
Another thing to note on the collateral end, and we've experienced this several times, you get to the point where you pay off your note, you know, that once in a lifetime, yes, I did it, I paid it off. And then 5 years down the road, you go to get another loan because you're going to do something. You're going to expand, you're going to grow, you're going to do something. And they're like, actually, well, you still have all these liens on you, have all these UCCs because the bank has never actually taken them off. So then you have to get all of the UCCs taken off from 5 years ago. So when you do pay a loan off, make sure you request that the collateral is released at that point. It's very important to do that so you can utilize that collateral later on. I really like what these two ladies have said about, you don't have to necessarily, you might get terms, you might get that yes from a bank, but you know, maybe if it was a little bit lower in percentage, or maybe if we could go an extra 5 years, you know, on repayment ability there, you can ask for those things. You're not always going to get a yes. There are some organizations and some banks that absolutely cannot do it. And, you know, they have a policy against it, or this and this and this. But I know Farm Service Agency can go 40 years. A lot of times they choose not to. You have to push for it. I know that some banks can absolutely take land out to 30 years, but they don't want to. You have to ask for it. There are certain things that I would recommend from a standpoint of somebody who has switched banks, moved states, bought several different properties along the way, sold a ranch. I would highly, highly recommend researching your banker or the next bank you're going to. Find out who they are. Do they work well within your realm of business? If so, go in and meet with them. And going prepared. That's a big thing. You know, you're asking them to really buy into your business. You really need to sell yourself. And this sounds terrible, but like, I went into a bank. I've been told no more times than so many people, because I just keep asking. And I'm like, well, it works, right? We can cash flow this, we can make it work. Well, we don't have the collateral. Okay, so how do we start growing then in a smaller way? And so going into a bank with your business plan, your cash flow, your business or your balance sheet and everything prepared, and say, this is why I need you. And this is why you should want to invest in me as a local business. I mean, I don't want to say get cocky, but you have to believe in your product. You have to believe in your business. If you don't believe in it, the banker's not. You know, you have to go in there and say, hey, this is what we're doing. This is why we're doing it. And this is how we're going to do it. We need your help. And this is what we need. So I'd say go in as prepared as you can, and right at our fingertips, you guys, we have some of the most amazing assets to getting all of these documents put together. You know, Olivia and the entire team at IAC, you've got Akiptan, you have tons of CDFIs, you have the Small Business Association. There are so many people out there that all we need to do is reach out, set up a meeting, and get you connected, so that way you can get help to do these documents. Because my husband, if he was here, he would tell you, he's like, there's no way I'm putting any of this together. I have no idea how to run Excel. I have no idea how to put a balance sheet together, but there are people out there that want to help to make this happen for you. So we have to reach out, we have to ask. So that would be my big recommendation on when we look at key factors of debt. Some of these are scary things. Ask and ask again. If you get no, if you get told no, ask again. Ask somebody else. Somebody's going to say yes if you believe in yourself. So there's my motivational pitch for all of you.
That's great. Thanks, Justine. I kind of feel like we ran through a lot of this in the next few already. So I'm going to keep going, but we've noted them. Everything Skya mentioned, Justine referred to. we have quick notes in them here, and obviously you have this recording as well. But as you're thinking about debt, the obligations you are taking on as a result, and then I really appreciate the anecdote, the story about taking off the liens once you've paid off the note. This is as shocking as that sounds, and as intuitive it might feel to you that this needs to happen alongside paying off the note, this is a really good reminder that things don't work that way. Resources and documentation that you may have to put together depending on who you're working with to bring together loans. So again, tons of sources out there in terms of financing. There are that you could reach out to figure out, what their programs are. Some of them have schedules, some of them don't. Some of them work with businesses in particular life stages, like cycles. Others will take them on, earlier or later. So depending on what that might be, there are things that you will find yourself needing to put together. Documentation just always helps. The separation of personal versus business. Like, if anyone has ever wondered, why do I need to do this? This is a very good reason to be doing keeping these things separate. And then having a good credit score alongside really, really helps your case, your application, your business. Your business, particularly as all small businesses, finally comes down to you and any other owners in it as individuals. And all of your credit scores collectively, whether it's a personal relationship and you're coming in as partners in a personal relationship, or you're coming in as partners in a business relationship, having each of your individual credit scores comes together to affect what is available to you as a resource, or in all of the terms and the rates that you get with your debt. What is a credit score? If a credit score, this was, I'm coming at this, I didn't have a credit, I didn't grow up in the US, and I came to the US as a 23-year-old with zero credit score, thinking that it was an amazing thing to have no loans. I grew up, in a family where taking a loan was just out of the question. You just managed with what you had. And I realized that in some ways that's a very good thing. And then as you're looking to grow and looking to finance what you do in the United States, not having an existing credit score can really hamper what you have access to from every, in every aspect of being, from just having a credit card to be able to buy a vehicle, to be able to set up a business, to be able to get a bank account. In some cases, it was like this vicious circle of you don't have a score, so you can't do this, but you can't do this until you have a score. And so, you go around in circles. What can affect and boost your score? There's a plethora of information out there on this. I'm going to note a few specific things. Sorry, my computer just did something very strange. Hang on a second. Okay. But starting to, if you are not aware of your credit score today, find out what it is. I'm going to say that's step number one. You need to know what your score is today. What affects it is what your entire history of any accounts that you have opened, any payments that you have made, any credit that you might be carrying, any checks that others have done on you as you're looking to access something new in the financing world, all of it affects your credit score. Paying your bills on time affects your credit score. Making sure that you're not constantly carrying a balance on your credit cards and making at least the minimum payments and not paying them off in full affects it. Making sure you close any accounts that you're not using. Things that you might have opened, like, hey, I have this card that I was just offered and now it's just sitting there. also affects your credit score. Closing too many accounts at the same time could affect it negatively. Opening too many accounts at the same time could affect it negatively. There are lots of things that go into making a solid credit score, and what you have there is going to affect what is available to you in terms of your rates, your terms. What other people are doing might also affect your credit score. So this is something that you have to be very careful about, because it is not rare to have mistakes in your credit reports. We've included a few. There are 3 main credit unions that track your score and essentially keep a score for you in the United States. TransUnion, Experian, and Equifax. Each of these will give you your credit report once every quarter, is it? That you're able to access it and be able to look at your report through them. In addition, Credit Karma is another site that you're able to look at your credit reports for free every once. I believe it's almost, Credit Karma has various levels, but there is a free tier where you're able to look at your report. Take a look at your report to see if there's anything off, because there may be, either intentionally or non-intentionally. There are people who could be using your information that you may then have to reach out and have corrected. There might be a bill that you paid where the payment just wasn't received, and it's now sitting as a blemish on your credit report. So this is a whole conversation in itself, but we wanted to put this in here to have you be very aware of, if there's one next step I would immediately ask you to do right after this webinar, it's to see what your credit score is and to make sure that you're aware of it going forward. Things to know with debt. If you're not sure, ask, look resources, reach out to us. You have access to us. Ask your local SBA, ask your bank, ask your credit union, ask your financial institution. There are no stupid questions. The only stupid question is the one that doesn't get asked. So just ask. You having a plan to support your application for a loan is critical. And so even if it's initially a sketch in terms of what you're planning, this is like basically everything that we've been discussing over the last weeks. How do you get this plan together? How do you think about your cash? How do you approach budgeting? How do you make sure you're tracking your financials? All of this feeds into a moment where you might be looking for external financing. Skya, I'm going to pause here for a second just so that you can elaborate on these further too.
Yeah, I'll keep it brief so we have plenty of time for questions too. Your loan officer should be your very, very best friend. Please be sure to work with them. I know that it is a very intimidating process. I know that it can be a very overwhelming process, but your loan officer is there to help you. Oftentimes producers, we see like little innocent white lies that they think aren't a big deal, but then in a year something happens, we find out and we're like, what you did would have been fine, but not telling us is the hard part, because we could have financed you this way, we could have helped you in this regard, and they end up shooting themselves in the foot. So honesty is honestly the key to success, because if we've got the full picture and we have all the information, one, we also trust you then as well, but two, we can set your financing up to like truly help you, and we can curate it to 100% of your situation, not 90% of your situation, right? And your business plan is critical. Be comprehensive, be conservative with your projections. Don't over project. That's just going to get you into trouble in the long run. Do market research, do a SWOT analysis. If you don't know what a SWOT analysis is, work with your loan officer. They will help you. We have tons of resources here at Akiptan. IAC has tons of resources. They're there to help. And so we're here to help build you up, right? And here to help you get there. And so that is our goal. And so just be sure to ask, work with your TA provider, work with your loan officer, and just all the things.
Very quickly, just going into the trade-off with debt. It's predictable, easy to budget for. If you qualify, it's often easier to source and work with than equity. It's usually less costly than equity because you're not giving away a piece of your business forever, depending on what the terms are. It allows you to maintain ownership, and any costs that you pay are usually tax deductible, so they do count as an expense. Obviously, the other piece that you have to be aware of is servicing that debt can eat into your cash flow. Depending on how you take it on and how you service it, it does put your assets, anything that you collateralize, and your credit rating, your score, at risk. It can be hard to access depending on where you are as a business, and it may be more expensive than you think. So be very aware of all of the costs associated with it before taking it on. I know we want to leave time for Q&A. I want to just very quickly note that we have a few factors in here to think about equity when you're thinking about how to bring on friends, family, third parties. Equity is a complex topic, and the one thing that I would put out there as a takeaway for it is remember that it's kind of like getting married. You're bringing in this person or this entity that is going to be a part of your business and the ownership of it for time to come until you're able to pay them off, buy them out, or separate in some other way. So if there's one factor that you think about with respect to equity is, can you live with this in the long term? And what is it bringing to you? Very much like partnership, personal partnership. And the pros and cons associated with it. Really almost the flip side of debt. So I'm going to stop here. Going to put this up to just say that we have fairly spelled out additional thoughts. The second one is the one that I'm going to note as the most key, like principle when I think about it. Don't take cash just because it's there for the taking. Don't. Take it because you have a good reason to use it, and you need it for something specific in the way you're moving forward with your business. Yeah.
Cool. Thank you. Awesome. And I'm going to drop in here our survey again, so everybody can get excited to give us some feedback. And on earlier in the chat is everybody's email addresses. Please don't hesitate to reach out. And from there, I'll open it up to some questions. There are none currently in the chat, but this is your time to ask these ladies everything you want to know. And again, we encourage you to just raise your hand or holler out, unmute yourself. Anjali, you can stop sharing your screen so we can see everybody. And then sign up. But holler out if you have questions.
Were we that thorough, you guys, that we don't have any questions at all? No way.
I mean, it's very accessible. Awesome. Awesome. All right. Well, any last thoughts from Skya or Justine?
I just always want to encourage people to reach out with questions. We're here to help. So you might not have any questions now, but you might in 5 minutes and you might in 5 days. So just be sure to reach out. So
I would echo
Awesome.
Skya on that. And if you guys are looking at some of these grants, whether it be the small ones or the large ones, I'm more than willing to help, by sharing what we've done, what worked for us, what hasn't worked for us. Some of them are really big and some of them are 3 pages. As far as, when we look at grant money. Another thing, just before we go, I want you guys to really, if you don't have a great relationship with your banker, your loan officer, try and mold that into a great relationship, because I want to echo Skya at this. When you find a bank, a CDFI, somebody who really believes in you and builds that relationship and that trust, it can make all the difference in your business and how you access that debt and build your own equity. So as much as we all hate doing our taxes and hate having to give away everything but our blood type, it is really beneficial to sit down with your loan officer and your banker and just say, this is what we want to do. This is how we want to do it. How can you work with us to make it happen? Having those open and honest conversations is key. So take the time to do that.
Cool. Great advice all the way through, y'all. And last thing I'm going to say is just that our next Meet to Market webinar is on May 18th. Still within our financial basics module, is called Who is a Farmer in the Eyes of the IRS? Tax Realities of Meat and Livestock Businesses in Indian Country. So we're going to talk about what's a Schedule F, what's a Schedule C, what's the difference between the two, what's on farm income, what's not, and what is exempt due to rules around tribal exemption. Really fun stuff. And we've got some great educators. So I encourage you all to join and tell your friends and tell your colleagues to join us as well. And thank you so much to Anjali and Skya and Justine for being here and being creating such accessible information. So it's awesome.